Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Let's invite the management now of JSW Infra. Now, the company reported a good performance in Q2. There was a healthy surge across parameters. The management has also guided for a stronger second half versus the first half. The stock has also done pretty well since its listing. It's currently trading at about 171, which is at a premium to its issue price of 119. We're joined by the company's joint MD and CEO, Arun Maheshwari, to talk about the way forward. Thank you very much for joining in. Before we talk about the second half, could you just give us an overview of the quarter gone by? How were the volumes? Where do we stand in the first half versus H2? And then if you could guide for the second half of the year in FY24.
So if I had to look only at Q2 of FY24 with respect to Q2 of FY23, the overall volume has grown up by 26%. The revenue has grown up by 29%, and the EBITDA has grown up by 33%. EBITDA has been largely higher because of the higher base of volume, and thereafter the operational efficiencies have kicked in over there. If I had to compare H1 to H1 of FY23 vis-a-vis HY24, the total throughput volume has been 17% up, revenue has been 16% up, and the EBITDA has been 17% up. So it's all in tandem, basically. So typically, one thing which we must note about that in India, the monsoon is very heavy, especially on the west coast of India. It's very, very heavy in Q2 of any year. Generally, the volume tend to go low. Historically, we have seen that H1 is slightly lower as compared to H2. So we will be witnessing that as we move forward. H2 is likely to be slightly better than H1.
No, got that. So, we've seen a few big-ticket acquisitions really coming through. So for the Fujairah acquisition, you've paid top dollar according to analysts, which is, which some are saying is expensive for a 95% utilization asset. What is the rationale here, and what could be the strategic gains over a period of time for the company?
We were never into liquid in a big space, and we wanted to get into liquid terminals. Fujairah is one of the top 3 business centers for liquid terminals across the globe. And we have been having a presence in Fujairah area for a long time. And we have a comfort zone, and we got this opportunity over there to acquire one of the assets over there. Of course, it is running at a higher utilization today, but there are growth opportunities within the same terminal. There's an additional land available nearby, which we can acquire, and we can build the terminal much more. We can bring operational efficiencies over there. This is a first foray into this kind of terminal business. Once we have a hands-on onto this terminal business, which is very, very safe zone to get into, thereafter we can expand our business presence within India as well on the oil tankage terminal side. So this has been our strategy to just go slow, go small in one of the terminals or one of the business line, and thereafter grow from there on once we have experience on that. That we have experienced in container, that we have experienced in LPG, that we have experienced in sugar. Now we are getting into oil tankage terminal. So this has been our strategy.
So the Sikar Logistics acquisition is interesting. How much are you paying for this asset? How much does it add to your books? We understand that it adds an important license to your kitty as well. Tell us a little bit about that.
Again, this particular acquisition is largely for getting into the last mile connectivity with the customers. We have not been into this space since our inception of the company. We have been into very dedicated manner. We have not been that open for any customer at any point of time for last mile delivery. This one particular thing which we were missing in our system, and we wanted to have an experience on this. So we have gone into the CTO license which was available, and we could negotiate, and we have finalized it. Now, by virtue of this, we would like to get connected to the customers directly from our port terminals and places. So this is one step towards getting into that missing link between the customer and the port. This is again as our strategy always goes, like go small, experience it, and thereafter go big if you find it really very accretive. We feel this has been our strategy in all our products, and this has really paid us well. This justifies what our investment rationale going forward as well. So this is one such step again towards connecting the customer and the port.
So what about the SP Group arm, Gopalpur Ports? Is JSW Infra looking to buy that for about 3,000 crore rupees, or is it an asset that you will evaluate if given an opportunity?
See, we are the second largest port operator in India, and definitely, any opportunity within India, outside India, good lucrative opportunity keeps coming to our desk and doors. We keep assessing several opportunities, and not necessarily that we'll go ahead with all the opportunities. But as of now, being a sensitive matter, and we have been into NDAs with several other companies, so we would like to leave it over there. And as the time passes, probably we can talk more about such opportunities.
But if you can give us a sense, I mean, which are these other assets? Are there several in sight, and just in terms of opportunities?
Being a big company with a good cash flow and a good appetite to grow, so several opportunities keep coming to us. We keep assessing those opportunities. It's not that we don't assess the opportunities, but how far we would be serious and how far we will go on these opportunities, it's only our assessment which will come out. Then we'll take a call on that. So as of now, we are not into any of those stages per se.
All right. Could we also try and understand what are the targeted EBITDA margins in the longer term? If you can, give us a comparison versus some of your larger peers, and what are the other capex plans that you have in place right now?
As comparable to any other greenfield port in India today, we also get close to about 65% kind of EBITDA margin in the greenfield ports. Wherein in the terminal, depending upon the revenue share, we get our EBITDA margins. A blended average, if I have to look at it, is close to 53 to 55% kind of EBITDA margin. If I have to take out the revenue share, assuming there's no revenue share, our EBITDA margins are close to 65% on all the assets. So it depends. It's a purely play of EBITDA margin, depending upon the revenue share what we have. Having said that, we largely are guided by the return on capital employed, not by the EBITDA margin. If you see our ROCE till FY23, if I have to look at the ROCE, it's about close to 20%, which is quite healthy in this industry. With having almost nil debt as of now, net debt to EBITDA is almost zero. So considering 20% ROCE going forward, it is going to go up if I don't do anything further from here on. So we are largely guided by ROCE.
And one final question, sir. Given the strong inorganic growth plans, the expansion, is there a capex outlay number that you have in mind, or any, the net debt to EBITDA levels that you're comfortable with?
See, capex plan would be guided by our internal target of net debt to EBITDA ratio, what we would like to keep. We have taken an internal guidance that we would not like to breach 2.5x net debt to EBITDA. So today we are net debt is zero. So we have good enough headroom to go ahead and do more and more capex. India is offering such opportunity. We have a healthy balance sheet, and we have an appetite to grow, as I said earlier. So this gives us enough headroom to keep on spending the money. If we have to talk about FY24, with these two acquisitions, assuming we don't do anything in the rest of the year till March, our net debt to EBITDA would still remain below 1, or rather still be 0.5 kind of numbers. It is most likely to be that. So having said that, we have good enough margin available to keep on continuing with a capex plan, keep on expanding and growing our business from here on.
All right, good conversation, sir. Thank you very much for your time. That's JSW Infra in focus. Now, let's just get back